right. All right. Good to have you, Isidore. Nice to meet you today. It's going to be a great time with you, Isidore. And okay, hello everyone. My name is Emmanuel Aguimi, and I'm the CEO of Emmviron International Business. So yeah, along with me is Isidore, the country director of Tribes Africa, specialized in Ghana. All right. So I, Isidore, we like to tell us a brief about yourself before we commence the session for today.
Yeah, so my name is Isidore. That's how it's pronounced actually. Um,
Okay.
and then the country manager for Trips. Trips is a mobility company which operates an app that enables commuters to book buses for their morning, afternoon, and evening rides on fixed routes.
Mm.
We are operational in Nigeria and in Ghana as well, and I'm responsible for Ghana. I have been doing technology for the past 7 years. I first started with in the fintech space. My first startup was called Westcape. It was a price comparison marketplace for financial services. And then I moved on to found Starbucks, which eventually became Trips Ghana after an acquisition with Trips. At the time, it was known as Plenty Welcome. Yeah, that's just a little bit about me.
All right. So thank you, Isidore, for your nice brief about yourself. All right. So today we'll be discussing about company valuation. So we get to understand that a lot of startups, tech products, startup and existing companies, they find it very difficult to value their company. So they don't understand, the necessary things to put in place. How they could acquire investors. What a percentage of their shareholdings or equity can they lease out and still have a larger percentage in the share. So what amount can they request for if they are willing to give about 10 to 20% of their shares to incoming investors or any venture capital. So I would like us to share more light, and making emphasis for companies who want to raise funds in their pre-seed stage, in their Series A stage, in their Series B stage, and in their Series C stage. I understand you have a lot, like you have some experience towards that regard. When you first started your startups, and even until now, you could share some bit of light about company valuation. So what can you say about company valuation, and how can you just please share some light about company valuation?
Yeah, so everything in this life has value. Um, a person has value. So that is what we call a net worth, which is the things that you own. So it could be in cash, in other assets like cars, real estate, land, equity, and many other things against your debt. So the fees that you owe other people. So it could be loans or against your liability. So it could be loans, um, so your taxes and other things that you owe other people or organizations. Then so your assets minus your liability gives you your value as a person or your net worth. The same principle applies to companies, but though in a different way. What the valuation that we are talking about here is not the same. The comparison is not the same as what I just described, net worth. But what I'm saying, the point I'm making is that everything in this life has value. Now,
Okay.
for companies or for startups, let's focus on startups. For startups, there's really no scientific approach or method or framework for determining the value of a company. There's no science behind it. Valuation, most of the time, is the opinion of somebody. Valuation is the worth of a company as seen by somebody else based on how they see the company.
Mm.
So, but most of the times, there are some guiding principles. So the sector in which the company is operating or the startup is operating in is the startup operating in financial services, in hospitality, in health, in education, in transport. And then another principle that could also apply or that could help in determining the value of a company is the stage. Is a startup or the company just forming up? Has the company acquired some users already? Is the company generating revenue already? Is the company profitable? Or so these the state of the company can also determine or affect the value of the company. The team, the experience of the team. So if you have people in the management who have worked at, for example, Uber, they've been in decision making positions at Uber, and now they've decided to start a company in the mobility space. This can also influence the value that somebody places on this company because of the quality of the team or the management. The market itself, how safe, how um, yeah, how safe is the market in terms of risk, in terms of deploying capital? If you invest in this market, is the return guaranteed, or is the money in a safe market? So investing in Africa is risky. That's what we hear all the time, compared to investing in other markets like the US or Europe, where the markets are fully formed. The regulatory environment is transparent, is efficient. So these things or these factors can affect the value of a company. And this is what investors most of the time use to value a company. But what you have to know is that when you are starting a startup, you should not be focused so much on value, because at the very beginning, some of these indicators that I talked about may not be in your favor. So then,
Mm.
what they have been some innovations in that space. We currently have something we call, a simple agreement for future equity. It's called SAFE. Simple agreement for future equity is called SAFE. So it's simply an agreement between a company or a startup and an investor to say that I'm going to invest in your company today because you're at a stage that you cannot be valued as a result of lack of data. I would invest in your company for future ownership at the time when the company is raising an additional funding at a priced valuation. So at the time when the company will be valued, will have enough data to be valued. So that is the instrument that should be used most of the time, safe in early stage financing. So these are some of the things that I can share right now as far as valuation is concerned, Emmanuel.
All right. So thank you, Isidro, for this wonderful insight. So you made mention of, you know, everything in this life has value. So and company valuation is an opinion of somebody, towards the wealth of that particular company. And you made mention of stages, valuing company in stages, and so and you made mention of also some factors that is put into consideration when valuing a particular company. You made mention of experience of the team. You made mention of how safe the market is, and also you made mention of some other factors. And you advise, okay, there is a particular agreement policy, a simple agreement for future equity, which startups can actually adopt to get investors. If they are complaining, if those factors are currently not in their favor, and you advise that startups shouldn't focus more on values. All right, so that's a wonderful insight, and I'll be asking you some few questions as along the way. All right, so now, for example, there are a lot of startups, there are a lot of tech products, that they've done they've set up a good tech infrastructures. They've acquired, they've been able to, the technical part of it has been sorted out. So now, what they want is they want to pitch their business. They want to ensure that, okay, they get strive. They get to the market space. They eat that break point. So and now they need a sum of amounts, to get to get their products to the market space. A lot of expenses and on marketing, setting up team structures, putting in place some other operations, and they need funds. And so in that regard, so what are you going to advise, since there are startups? We have a lot of startups, here in Nigeria, especially in the fintech space, that they've like, once they get started, within the next 1 or 2 months, they've been able to they've been they are valued for millions of dollars. They are valued for millions of dollars, and that has been in the art of young and small growing businesses and startups. That, okay, we as well have like a tech product that we feel that is quite cool, and can actually, and we can pitch it to the world, pitch it to the world, and we'll get a number of traffics. But right now they don't have the source, they don't have the capital, and so in that scenario, so what you advise, because they need to value their complaint, based on all these particular factors, and they need to get to the. So what's your advice? Do you want them to just get started, or is it advisable to value a company idea, like an idea, and outsource for investors, before even launching? And is it advisable to just to seek for investors, go seek for a lot of some investors, and also reach out to venture capitals, and also some startup programs, like Techstar and the likes? So is it actually so what's your take on it?
Yeah. So, um, first of all, it's very hard to value a product. A product is a property of a company. And I noticed that some startups or some founders like to focus so much on the product. So people are just concerned about building a very nice app or software with all the best UX, with all the best UI, and then think that they can sell or value that app or that software or that technology. But it doesn't happen that way. That's not what you value. You value the company. So that's what I talked about. You value the company, and the company, and the product is part of the company. So is also the team, um, the market in which the company operates, the users or the customers that the company has acquired over time, and so on and so forth. That's what they use to value a company. So people should not focus, or founders should not focus on product alone, to earn a higher valuation. Now, secondly, some of the companies that you refer to, or the companies you refer to, that are raising significant amount of money within a short time of existence. Again, I will refer you to my earlier statement. These are people who may have already achieved something significant in their professional life in the past, and will leverage on these achievements or this track record to raise money quickly, that the average founder will not have been able to do, because they don't have the network or the track record. The second point is that they may be operating in a sector that is very attractive to investors. And you did mention, or you made reference to financial services or fintech or financial technology. And fintech is among the top 10 and the top 5 areas of interest for investors, not just in Africa, but across the globe. And for that reason, investors are willing to bet their money on the best team, the best products, in the best market, as early as possible, so that they can cash in. The earlier you invest in a company, the more you can get to benefit later when its valuation rises. The other thing that people have to know is that valuation also rises. So you cannot start a business and say, I'm valuing my business as $2 million because I think that it's operating in a great market. I have the best team, I have the best product, and all of this and that and so on. No, valuation accumulates over time, or it grows. As the company grows in acquiring more customers, as the company grows in generating bigger revenue, as the company grows in creating more value in the market, its valuation grows as a result as well. So whoever invested early on in this company would benefit significantly from the future value of the company, because then they would have bought stake in the company at a small price. So if a company is valued today at say $100,000, just as an example for the purpose of this call, and then I take 10%, I invest maybe 10,000 and I take 10% of this company. In the future, or in the near future, let's say down the line, within 6 months, 8 months, 12 months, 18 months, 2 years, this company is valued at $10 million. I stand to gain more compared to other investors who would have invested in this company when it was probably valued at 2 million or 3 million or $5 million. So
Yeah.
that's the thing about investment, and that's the thing about valuation. That's the thing about products versus company valuation.
All right. Thank you, Isidro. All right. So that's a wonderful insight there. So I'll be asking you this question again. All right. So if a company like a business wants to categorize their startup into pre-seeds, into Series A, into Series B, and into Series C. Some people don't really understand. Okay, what exactly? How can I classify? Will I say I'm currently in the series in the pre-seed stage? Will I say I'm currently in the Series A stage? Will I say I'm currently in the Series B and C stage? Because a lot of startup founders, CTOs, and CEOs don't really understand that concept. Okay, within this the pre-seed stage, the Series A stage, the B, and the C. So I will love you to share more light on those stages and how can businesses or companies position themselves within those particular stage.
So businesses grow in or form in stages. There's the pre-seed stage, or there's the early stage where the company is just building or conceptualizing an idea and turning this idea into product. And in some cases, the company is seeding. The company is now growing some seed, which is a product. And some companies may need money eventually to build or to commercialize the product. So I may have prototyped a new hardware, maybe a new glass or glasses for visualizing things at a longer distance. So with this new innovation, I can wear this glass and visualize things from a very long distance. But my money has only been able to produce this product, maybe just one or two, and it will still need some improvement before I can sell it to other people. Now, this company is just forming with each product. This company will probably need a pre-seed fund. So because then it's very early, it will need a pre-seed fund or an angel investment in order to help it build the product or commercialize the product to a stage or to a level that it can be commercialized or it can be sold to the market. And when this company manages to raise a seed or a pre-seed or an angel investment and eventually meet some metrics or deliver some numbers that prove that the business is viable, the company would need an additional money or additional fund to grow its user base, to further validate its product, its business model, especially the business model. So you have proven that the market needs a product. You have proven that the market, you've proven that you can build a product. So you've gotten some pre-seed money to build a product at a commercial scale. Now you will need money to prove that as many people as possible need this product on a larger scale. Maybe you sold to 200 people at the pre-seed stage. Now you want to sell to 1,000 people. And then you want to also prove your business model. Is the pricing framework that you use, is it sustainable? Does it make sense? So you will need an additional money to do this. At this point, you are growing the business. So you need to invest more in engineering. So if you're hardware engineering, because in this case you're producing glasses or hardware, you need to invest in customer support. So people then, when you start advertising this product, people will start calling to ask questions and all that. So you need to invest more in customer support. You need to invest in marketing because now you have proven that you can produce the product at the commercial scale. You will need to reach more people. So you need to invest in marketing to reach these people. So this is what you raise the money for. You raise money to grow the product, to build the product for a larger market. You need money to invest more in marketing. You need money to invest in customer support. Then once you raise, in this case, the money that you'll be raising is called a seed funding. Now, after that seed funding, once you've managed to validate your business more, you've managed to validate that, look, beyond 200, there are 1,000 people out there who need the product. You've managed to validate that your marketing strategy is working very well. You validated that customer support is doing very well. You need to further expand the business. You probably want to start producing a different color of glass or a different type of glass for children, or you want to start selling to as many as 10,000 people per month so that you can be more sustainable. That's when your next round of funding comes in. So that would be, it could be Series A or pre-Series A, depending on the nature of the round that you're raising. Some companies will raise seed, and then the next stage will be Series A. But before the Series A, they want to raise some small, some top-up investment. I'm using top-up for want of a better word. So they want to add an additional amount to the earlier investment that they raised. So they will raise something small. Maybe they raise $200,000 for their seed round. They will raise 100,000 in addition in pre-Series A to cover some expenses quickly before they raise their Series A. Then after the Series A, you want to launch in a new market, or you want to continue to grow significantly because then your business is growing, there's more demand. Then you raise Series B, and the cycle continues based on the needs of the product of the company. You raise Series C, Series E, and so on and so forth. So that's what the different stages of investment are.
All right. Thank you very much for that wonderful insight, and I hope our audience learned something very insightful. So our last question now goes to and now we want to get investors, angel investors, venture capitals. We want to apply for some startup tech programs and some other ways to get investment and to boost their complaints, and achieve expectations, basically. So now, what is the necessary document needed by startup founders to set up and start acquiring investors? So what documents, like what the necessary documents that they need to put in place before they reach out and start getting investors, angel investors, venture capitals, and some other programs and companies to come and buy into that initiative.
Okay, great. So the first thing you need to start communicating with the investors is your pitch deck. And your pitch deck is your basic tool as a startup for fundraising. Your pitch deck should be 10 slides long, ideally, or maximum 12, because you are not going to talk about everything there is about your company in that document. You're simply going to offer something enticing for the investor to want to follow up or take another meeting with you. So ideally, you want to talk about the problem, the business model, the opportunity, the team, most importantly, the team, and then of course, your business model, and then some basic financial projections, how much you intend to make within this period, what are you raising the money for, what are you going to spend on when you raise what the money you're asking for, and there's no particular order. I would argue that there's no particular order in structuring your pitch deck, even though there are some conventional standards flying around. The thing is that you have to tell a story, and based on your situation as a company, based on your stage, based on the product, and based on your customer, you can tell a story in different ways. You can tell a story by starting with a problem. You can tell the story by starting with the opportunity. You can tell the story by starting with the team, because the team is at that point maybe is probably the biggest asset of the company. Okay, so there's no particular there's no particular order for structuring the pitch deck. That is one, but the pitch deck is the first two. Second, you must already have a registered company. That is basic. If you're going to raise money from somebody, they're going to pay the company the money. They're going to pay the company the money, not you as an individual. The money is not going to go into your personal account. So you must have your business registration document set and other statutory requirements from the market. So if it's a tax certificate, you must also have it ready. That sort of thing. If you have to register for employee, some employee a payee certificate or employee tax certificate, based on the market, you do all of these things. And then you have your financial projections. Your financial projections look at the health of the company in terms of numbers. So again, the templates can vary from company to company and then from stage to stage, from sector to sector. But you should have some financial projections, because these are the things that people start asking for. Let me see once there's interest, you send a pitch deck and there's an interest, they'll say, okay, let me have financial projections. Then let me have people will start asking, I want an extended profile of your team. So people will start, maybe give me an extended bio data of your team. They'll start asking, how much have you spent between this period and this period? How much have you made between this period and this period? How much are you losing or how much are you generating in profit? You should have all of this data at hand. You don't wait till it's fundraising before you start doing this. It would be very stressful and you might make mistakes. What you do is you have a data. You have a data room, or you have a folder in Google Cloud, or Google Drive, or Dropbox, whichever cloud storage service you use. Have a folder over there. Now departmentalize the folder. So you give it if it's a company, your company is called ABC, give it ABC data room. Now in that folder, you have revenue, you have financial projections, you have team data, you have pitch deck. So anytime an investor requests for information, it's not that they're going to do it. Every day you're updating this folder, live in the cloud, and you can share it instantly. These details are important in building a better impression or in sending a better impression to investors. Because you don't want to ask somebody, send me your pitch deck, and it takes them 20 forever to send it. Send me a financial projection, and they don't know what they're about. You don't want that. So these are some of the things that you need to properly raise money. The other thing that I would also advise people to do is to know how to use Excel. Excel is important. Sometimes people say that, look, I'm not an accountant, so I don't need to use Excel. But look, it doesn't make sense. Excel is not for accountants. Excel is for helping you to calculate numbers and make decisions. If you're in a position of making decisions all the time, you have to know how to use Excel, because you have to make some decisions based on numbers. So know how to use Excel, basic Excel formulas.
All
Yeah.
right. So thank you, Isidore, for your time. All right. Thank you very much, Isidore, for your time. It's a nice initiative. We got a lot of a lot of concept, a lot of insight from this short podcast session. All right. So I now to recap what Isidore said to you guys. Now he said the necessary document needed to set up and acquire investors. Now, one of it is the pitch deck. It's very important. So, in as much that there is no particular order to structure your business pitch deck, so that you will ensure that that you make your pitch deck should be at least 10 slides long and maximum of 12, and you need to input. You don't need to talk about everything, but we talk about what investors is actually very interested to know about. Now, one of it is your problems, and what problems are you trying to solve, your opportunities, yeah, and your business model, and most especially your team, then your basic financial projections. So now that's going to give the investor a good impression about your business, your your company basically, and how you guys are set up, especially now putting in place your team profile. So now you need to register your business. Now you register your business, and you need to get other statistical certificates, ranging from your taxation certificates and some other necessary legal documents to back up the validity of of your company ownership. And also your financial projection, very very important, because it is what the company, it's what investors were going to use to see, to know if your business is going to be viable, is if the figures are considerate, and if and how well you can actually play around with those figures to bring out something insightful and something interesting that can captivate them to invest into your business. And also your extended profile of your team is also one of the things that you need to extended profile, they need to, so the type of team you're going to acquire determines the level of at which investors rate your company. So all this, and also making use of Excel. So you need to have basic knowledge about Excel. So data is one of the key aspects. We see there are made emphasis on, and which is what we're gonna say that okay, in Emmviron International Business, we are a business plan analytical firm. So we help businesses thrive better in the market space with the right strategy and input. So now, like you said, the necessary documents, we help founders, business owners, and entrepreneurs set up a well presented pitch deck. So where you could be able to have a picture that is as enticing for investors. We can help you with your financial projection. So we can help you develop a unique business model, a business model that works. We've worked with some clients, and clients can actually we've been able to get a lot of number of reviews from our clients about business model, on how we develop structure a well developed business model for them. So we help businesses structure their business plan as well, provide them with financial projection. So if you in any way, you want to set up your business, you want to achieve business expectations, you want to start, position yourself in that line to get investors. Like Isidore said, you don't need to it is not when you need investors or investment that you should put all this document in place. You should at least get them. So because when investors comes and those documents are not in place, you will find it very it's going to be very tough, and you might be able to, you might be missing some details. So do it now, when it's still fresh. So, and also, I just wanted to announce that we'll be launching our corporate training session, corporate training, by January. So more information is going to be on our website, and we're going to keep you guys updated. So, next time, same time, we'll be having and we'll be discussing on another business concept that you guys will be interested on, and we hope to see you there. So thank you guys, and one word from Isidore before we round up the session.
So I like people to focus more on building value rather than focused on building valuation. One of the things I've learned is that you go into every meeting by offering value first. When you offer value first without expecting anything, you'll be surprised at things you can get in return, a lot. So people should be focused on offering people value. If you're a customer, if you're a business, can you offer your customers something for free? First of all, by telling them the problem they have, and by telling them you can solve the problem for them this way, without even asking for any money in return. So this is important. These are the things that would help to build the value of your company, which eventually would impact on the valuation. If you're talking to an investor, is there anything you can say to this investor to let them know that first you are interested in solving the problem and providing a solution that's adequate enough, rather than I'm just interested in your money, because investors are not looking to give money to people who are just interested in collecting money, but they want people who can solve the problems and grow the business eventually to a stage that is really worth something for their money. So focus on offering value, on building value rather than optimizing for valuation. Valuation would come eventually when you offer great value to the market. Thank you.
All right, so thank you, Isidore, and thank you everyone for listening to our podcast. And do have a lovely day. Cheers.